You're interested in wealth management, financial planning, investing, and financial freedom, but don't know where to start. Okay, let's talk about wealth management and how to get started. Welcome to another episode of Money Matters. Let's get started with the younger demographic, the graduates. You've gotten your first job. How do you begin to plan your finances? First things first, you start saving as early as you can and as much as you can. As exciting as earning your first paycheck is, do not get into the habit of spending every penny you earn. It's very difficult to save the money you're already used to spending. It's understandable that living expenses may be high, but the truth of the matter is you have to be brutally honest with yourself and trim the excess fat. The rent you're paying is making someone else wealthy. Now that you're saving, build up on your cash reserves in the bank is perfectly fine to 6 to 12 months worth of living expenses or more. This will act as your emergency cash buffer for those unexpected financial emergencies. Then the fun begins. We can begin to invest. And this is where you can get your money to start working for you. When it comes to investing, I want you to simply think of investing as buying assets that generate returns. It may appreciate in value and or generate an income. To get started, we're simply talking about buying financial assets, which include stocks, bonds, mutual funds, and ETFs. There is a plethora of packaged financial products out there being marketed to investors, but remember that the focus is on the underlying assets themselves, and do not place too much emphasis on special features or marketing gimmicks of any pre-packaged products. Remember that it is the underlying assets of any product that generates the returns. For nearly all investors, it makes sense to ensure investment diversification. The benefit of diversification is to manage or mitigate some of the short-term volatility of the investment portfolio. A globally diversified portfolio will largely follow the movements of the global markets. You may wonder why this latter part is a benefit. Rest assured that a globally diversified portfolio that tracks the global markets will deliver satisfactory returns over the long term. Note that the more you deviate from the global markets, the more you either benefit from outperformance or, if you get it wrong, the more you underperform the global markets. There's nothing wrong with trying for a more tactical investment portfolio if you think you can get it right. But rest assured that the global markets, through the good times and the bad times, will eventually continue to rise. You can see my video on why markets always eventually rise by clicking on the link. To build diversification into a portfolio is to buy a bit of everything, usually weighted in accordance with world market capitalization or perhaps weighted in accordance with world GDP. Rather than buying individual assets, you may consider buying collectives such as ETFs or mutual funds. These encompass within them a variety of assets, so the task of building diversification into your portfolio is made easy. You can see our video on how to build diversification into your portfolio by clicking on the link. When buying assets, there are really two main asset classes to consider here: shares or equities and bonds. We'll focus on these two for now as we're just getting started. In simple terms, equities are considered the higher risk or more volatile asset class, being subject to greater swings in price. The trade-off is that equities are expected to generate greater returns in the long term. You'll expect an equity portfolio to generate capital gains and also perhaps to pay out some income in the form of dividends. A bond or fixed income portfolio may or may not increase in price depending on your strategy. But the emphasis is on the fixed interest payments you receive, hence the name. In general, most investors have a medium to long-term investment time horizon. Note that we're not talking about market speculators who focus on timing the market to make short-term capital gains. Therefore, with time on our side, we can opt for a more equity-biased portfolio to benefit from greater long-term returns, with our longer investment time horizon being our best mitigator of short-term fluctuations in the market prices. You can visualize the differences on this chart here. There are certainly other asset classes such as property and commodities you may consider, but that's beyond the scope of this video. It is important to remember that each investor has their own goals and objectives. Therefore, it is important to recognize that we are generalizing here and that you should seek the expertise of a professional to tailor a solution specific to your own needs. On that same note, it is too general to say that you should be saving a certain percentage of your income, so I won't. Instead, you should identify and then quantify your desired financial outcomes. These financial objectives should be linked with your bigger picture goals. After all, what is there to wealth generation if it can't be enjoyed or put to a good cause? For example, one of the first big goals for younger investors is to accumulate enough capital to put down a deposit for a property. Perhaps it will become their family home. Depending on the individual's disposable income and thus how much can be saved on a monthly basis, it is easy to estimate how long it will realistically take to save this deposit. Also, a prospective home buyer must take into account other expenses such as stamp duty, conveyancing fees, furnishings, etc. Total this up, and that's the target to hit. On the other side, the factors that affect the investment outcome are how much is invested, how long the investment runs for, and the returns of the investment. Note that your actions in the earlier years have a huge knock-on effect on future outcomes, more so than people realize. For example, $10,000 invested per month over 40 years totals $4.8 million. And if it grows at a reasonable 9% per annum, the final value would be nearly 10 times as much at $47.4 million. But more so than that, taking action early and saving as much as possible means you can acquire property early, pay off your mortgage early, be in a better position to acquire additional investment properties or holiday homes, be in a better position to fund your children's higher education fees, and be able to retire early. The list goes on. It's a chain reaction in the most positive of ways. Time is of the essence, and carpe diem indeed. Let's be honest, not everyone considers wealth management or even financial planning from a young age. Many focus on climbing the corporate ladder or building their businesses first, whilst others simply just put it off till later. The fact of the matter is, many successful individuals are so focused on the present, they neglect to look ahead to the future. However, whilst it's never too early to start, it's also never too late to begin. Usually with career success comes a lack of personal time. A lack of time means your financial planning and wealth management to-dos get pushed to the bottom of the list, never to see the light of day. In this case, hiring the help of a professional certainly pays dividends, pun intended. They will structure a plan specific to your needs, helping you to aim for a financial outcome that is in line with your aspirational future. They will manage your finances on an ongoing basis, adapting your portfolio according to changing market conditions and evolving with your changing circumstances and objectives. They will save you time so that you can get on with your daily tasks whilst knowing that your wealth is working as hard as you are. The trick is to find the right professional. Don't go looking for the brand. Look for the right individual in your chemistry and develop a trusted relationship. Look for transparency, look for simplicity, be mindful of costs, know what you are paying for. Be clear on what your goals are and be able to articulate them to your wealth advisor. Don't be tied into long-term products. There's simply no need. Instead, it should be in the wealth advisor's interest to deliver on performance and service and to win further trust from you. There should be no restrictions to take your money back whenever you wish. I will also say this, try not to go looking for exotic investments. A good investment doesn't have to be something that no one's heard of. The names that everyone has heard of are easily capable of generating fantastic returns. Just think of Apple, for instance. I see far too many people looking for the secret sauce or looking for shortcuts to win big. This is particularly true of those who have not done enough financial planning in the past and feel they need a shortcut to catch up. Do this at your peril. In most cases, the risk isn't worth it. In most cases, it's a balancing act of prioritizing life goals and aspirations. In most cases, financial planning and wealth management involves some form of compromise. There is no silver bullet and there is not a perfect outcome. For those starting a little later, you're effectively spinning several plates at the same time and ensuring you attend to each goal simultaneously. It is important to identify and quantify your goals. Do not just invest without having a clear vision of what you're trying to achieve. For many at this later stage, the main focus is on retirement planning. The children may be in their final years of education and soon to become financially independent, hopefully. The family living expenses have or will reduce significantly, and the aim is to make some final preparations to ensure that you can enter a comfortable retirement lifestyle. What is comfortable is very personal, but it's true that higher earners will have a higher expectation of their retirement. This stems from the fact that it is difficult to downgrade your lifestyle. As I say from time to time, once you drive a Mercedes, it's difficult to go back to a Toyota. No offense to Toyota. That being said, it is near impossible to maintain the same level of income in retirement. I.e., if you were earning a monthly salary of $300,000 per month, for example, it's unrealistic to expect this level of income after you retire. And this is true of any level of earnings. Given that the life expectancy of populations nowadays is reaching into the 90s, and assuming we retire at a nominal age of 65, that's 25 years of living expenses. Therefore, the amount we need to save is huge. Whilst it's true that our living expenses reduce due to the children becoming financially independent and large debts such as mortgages being cleared, and the fact that we simply have a less active lifestyle in our later years, one major factor means that we all will spend a lot during our retirement. Time. We have a lot more time on our hands because we no longer go to work. All those hours in the office are now available to us. And as soon as we leave our front door, we are spending money. Of course, our personal hobbies and pastimes determine how much we spend. These again are determined by our earnings power back when we were working. Therefore, it is important to visualize the retirement lifestyle we may want to lead and total up the cost of living this lifestyle. This is the process of identifying and quantifying our retirement goals. Putting a number on this gives us something to aim for when setting up and managing our investments. One of the biggest myths for investing on approaching retirement is to de-risk as we approach retirement. This is wrong, and I'll explain why. The idea behind de-risking is that your investment time horizon ends upon retirement. Therefore, the aim is to protect this accumulated wealth in the final few years in case of a market downturn. In reality, it is unlikely that an individual will spend the whole amount in one go upon retirement. And it is unwise to simply disinvest it all and leave it as cash, for the silent deadly killer of wealth will erode that cash pile. It should remain invested to generate returns that will provide an income throughout retirement. And thus, the investment time horizon actually continues for many years to come. Simplified to a few key points. The investment time horizon is actually much longer than we once thought. There is a need to continue investing to generate sufficient returns throughout a long retirement. And a long time horizon will mitigate much of the short-term fluctuations in the markets. Newcomers to wealth management may be lured by investment products with special features and USPs. These products being specifically designed to look attractive to specific target markets. Remember that it is the underlying assets that generate the returns. Focus on these. Whether the underlying assets are mutual funds, ETFs, bonds, or shares, Whatever your investment strategy or approach, the underlying assets are what generates the returns. Look for investments with transparency. Look for simplicity. There's simply no need for these plans to take years to break even because it pays its agents huge upfront commissions. And there's simply no need to suffer imposed exit penalties that commit you to these plans for years and years. Know what you are paying for. It should be simple and clear. If you are managing your own investment account, it should be relatively low cost. If you are using a wealth professional, the cost is expected to be higher, but know what you are paying for and expect added value in the form of performance and service. You can see my video on DIY versus hiring a professional by clicking here. Overall, if you're thinking about getting started, don't think and don't delay. You've got to be in it to win it. Our human apathy is the greatest threat to our future financial success. Save as early as possible and save as much as possible. Visualize your aspirational future, identify and quantify your goals. Buy assets and not gimmicks. Seek transparency and seek simplicity. Be cost aware and know what you are paying for. Use diversification. Think long term and remain steadfast. Regularly review your progress and consider using a dedicated professional. Have confidence and remember to have fun, knowing that you are making continual progress to your financial freedom. Thank you for joining me on this episode. Let me know what other topics you would like to hear about in future episodes. If you like the video, smash the like button, subscribe, and I'll see you in the next episode of Money Matters.